Hey guys, welcome back to our YouTube channel Accounts Gurukul. Learn accounting online. So today we are here again to discuss about R2R financial reporting, common mistakes and how to avoid them. So here we are going to discuss what sort of common mistakes we do when we are doing the financials reporting, and considering that, how it's important for you to know that you're going to avoid that. That's all we are going to discuss here. This is going to be the helpful for um, reporting team. This is going to be helpful for the finance controllers as well. This is going to be helpful to the leaders and the business owners as well, to know how it's going to be impact on the financials reporting if such kind of mistakes, such kind of errors, if your team is doing, and if you are not aware about all these processes, what sort of mistakes going to be there, your team is going to be there, how you have to ensure that to avoid and not going to be there in the future. So that's all we are going to discuss here. So request viewers to be with us till the end, since considering this year end, this is going to be important, since this is going to be the last month for this financial year. And when we are going to do the review, we have to ensure that there are not going to be any scope for any issues. So considering this one is going to be helpful for everyone related to accounting and finance. So request viewers to be with us till the end to know more about this. Like, share, and subscribe our channel to get a more insight related to accounting and finance. In addition to that, if you want to go for any sort of training, or if you need any sort of consultancy related to accounting and finance, then you can connect with us on our email ID. That's accounts.gurukul@yahoo.com or finance@w for llp.in. So we'll jump towards the financials reporting, common mistakes, and how you're going to avoid them. So before going to do that, first we'll just ensure how it's going to be impact on our financials reporting. In the complex world of financials reporting, even the most professionals can occasionally stumble. So that's going to be there. Even the person who has a more experience, he is also is going to be have some issues. And we have identified common mistakes that can have significant implications for your business. And whether you are an experienced accountant, an experienced auditor, a leader, or a business owner, understanding these pitfalls and learning how to avoid them can help you maintain the financial health and integrity of your organizations. So it's very important for everyone. And we know we are all human beings, and the issues going to be there some, but due to that issues, how it's going to be impact on our financials reporting, that's important. And when we identified that, how we have to overcome, that's also is going to be important, and to ensure that's not going to be repeated in the futures. And we have to follow the four eyes principle. Someone is going to do and somebody else is going to do the review. But before that, if we know what sort of issues going to be there, then we will be more vigilant to ensure that issues not going to be there well in advance. That's we are going to discuss here. So the first we'll discuss from the revenue side. Inaccurate revenue recognitions. We know this is the most important accounting standard towards this revenue, and that's going to discuss about through the accounting standard 9 towards revenue recognitions. When you have to recognize the revenue, if you don't know, then that's going to be create a problem for your financials reporting. And this is always going to discuss based on our own experience, knowing that we have 18 years plus experience into accounting and finance. And considering that, we are discussing all these things. Inaccurate revenue recognitions, how it's going to be impact. If you deliver the materials you have the contract with your customers that the delivery term is at your end. You are going to deliver the materials. The risk is towards you. And if you raise the invoice on 25th of March, and this is once again is ensuring to all of you is that this is all is going to be important from this financial year end as well. There are sort of few mistakes you have to ensure from the year end standpoints. You have to ensure the revenue recognitions. This is going to be impact from the accounting standards, and this is one of the auditor's checklist as well. As per the checkpoints, this is important. So when your goods delivery term is after the delivery term is going to be delivered at client place, and you generated the invoice on 25th of March, today is 23rd, after 2 days. And it's going to be take 1 week to reach at client place. That's going to be probably in the first week of the April is going to be delivered at client place. And your agreed term is to deliver the delivery is at your scope and you have to deliver at client place. Then the day when you generated the invoice on 25th, you book that in the systems as a revenue. But either that revenue is generated or not, that's going to be important. And how you are going to define that, how you are going to evaluate that, that's all is going to be depend upon the your delivery term. What's delivery term is agreed in these transactions. If it's going to be delivered at the client place, it means till the time that's not going to deliver at client place, you don't have right to recognize the revenue in your books. That's based on revenue recognition standard, accounting standard 9. So there are certain conditions for that related to services, related to goods. The one which you have to keep in mind is that you have to recognize the revenue as and when you deliver the goods or services. When you transfer the risk, when you transfer the possessions, then only you have to recognize. Else, you don't have right to recognize the revenue. And considering this year end, if you are doing the such things, then auditor going to ask you to do the reversal of that. So, and if you are following your quarterly reporting, half yearly reporting to the management or monthly reporting, you have to ensure you are ensuring you have the you book the revenue correctly. Accrued income also is going to be the part of this revenue recognitions. If there are certain income is accrued related to your FD interest, but you haven't booked that in the systems, that's also not the right. So there are lots of issues is going to be there in financials reporting, and these are all the common mistakes. And we hope you are going to know how you have to avoid, and in addition to avoid, how you are going to ensure that's not going to be repeat in future. That's the intent. Inaccurate revenue recognitions. The mistake, one of the most common errors in financials reporting is inaccurate revenue recognitions. This can occur when you are not aware of revenue recognition methods and revenue is recognized too early, too late, or not at all. That's going to be create a mistake. Then how you're going to overcome that? Ensuring you and your team is familiar with the revenue recognition principles and the specific guidelines of your industry. That's so important. Implement rigorous review, put checklist and internal controls to verify that revenue is recognized accurately and in the correct reporting period. That's the important. The correct reporting period with more accuracy. That's you have to ensure. Inaccurate revenue recognition. This is the first point towards the revenue. This is a common mistake. Next is going towards the failure to do the COGS analysis. I observe that the most of the you can say the most of the entities who have the turnover is around 50-60 crores or less than 100 crores, they never go to do the in-depth COGS analysis. They just need to ensure that the analysis is going to be the roughly says that how much is the gross margin we have from the 10 to 15% or 15 to 20% or 20 to 30%. But when the reporting is going to be there, they used to just ensure that how much we have the average gross margin, it's around 50 to 25 to 30. Yeah, in between that, yes, then there is no need to worry. We are okay. Just go ahead. But is this the right way to do the review? Might be. There's in few invoices, few sales transactions, we have the huge margin. But on a few, we are in negative. Then how we are able to know if you are going through the average analysis? So don't do that. We have to go in depth. We have to see for each and every transactions how much we have the gross margin. And wherever we have the negative or less as per our thumb rule, then we have to go into the depth and ask the team to do the analysis. So failure to do COX analysis. As a thumb rule, ensuring the gross margin is within the range is not going to solve the purpose. To know either we have been maintaining the good margin in every transactions or it's just the average gross margin. How you're going to avoid that? How COX analysis for each and every sales transactions with respective items to know either we are ensuring the gross margin or not. And wherever there is a red alert, we have to go into the depth and to know what's the cause for that. Or else we are going to not have a good margin of that transactions. Next is going to be misclassification of the expenses. So this is also going to be the problem. If you don't know what is mean by operating expenses, what is mean by capex expenses, what is mean by your prepaid expenses, then how it's going to be work? If you are booking the prepaid expenses within the current year as an expenses, now it's the 25th or 23rd of the March. You are on a year end. If you have any software subscription services, if you availed any insurance, and if your team is not aware about that, either that time frame is going to be for 2 years, 1 years, and you are booking everything in within the this year itself. AMC is renewal, but you are booking everything in the current year itself. How that's going to be work? So misclassification of the expenses says that expense is going to be parked into the balance sheet as a prepaid expenses, but you are hitting in the P&L as an expense. In addition to that, capital expenditure and operating expenditures. If the capex expenses you are booking in the P&L as a OPEX expenses, then that's going to be create a problem. So you have to understand that. You have to be well uh, educated about all these things, or else that's going to be create a problem. The mistake misclassifying expenses as a capital expenditures or vice versa can distort the financial pictures of a company, affecting its profitability and tax liabilities as well. How we are going to avoid them? Understand and educate team with the difference between the capital and operational expenses. Put some approval metrics in place for high value transactions. Capital expenses are investment in long-term assets, while operational expenses are cost incurred in the day-to-day running of the business. Next is going to be inadequate provisions for bad debts. That's also going to be create a problem. Overestimate or lower estimate, both is going to create a problem. The mistake, underestimating the provisions for bad debts can inflate your company's net income and accounts receivables, leading to an overstatement of assets and profits. How to avoid them? Regularly review your accounts receivables and adjust your provisions for bad debts based on historical data, aging analysis, and current market conditions. Just don't create the provision for bad debts into the year. There should be the solid backup for that. You have to do the review of your aging report. You have to get the update from the respective your customers, collection team. You have to see the market conditions, and then only you have to decide how you're going to take the provisions for bad debts. If it's underestimate or overestimate, both is going to create a problem. So, inadequate provisions for bad debts. Incorrect use of accounting principles. If your team itself is not able to know that what's the accounting principles, then how the accounting is going to be do? That's also the important questions. Then you have to ask sometimes to your team as well while you're just walking here and there. Hey, which one principle is we are following for accounting? How many principles you know? What is that principle is going to be says? Then you are able to know that where is your team to whom you have handed over your accounting. Either they know or That's going to be questions you have to ask. The mistake, misapplying accounting principles such as the matching principles or the principle of convertism can lead to significant discrepancies in financials reporting. If the matching principle, your team is not aware about that, they are just doing the focus towards the sales and whatever the cost is incurred towards that, that's a cox is booking into the systems. But there are, other than the costs, lots of other cost also is going to be incurred to see that sales is going to be there in the place. If you have agreed commission to someone on their transactions, you've done the your sales, you book the costs, what about that commissions? Since that commission is agreed for that sale and your team don't book that commissions before March end or within that month end, then that's not the matching principles. The matching principle is going to say that whatever there is a revenue, towards that revenue, whatever expenses that's a direct or indirect you incur, you have to book in the system. That's the meaning of your matching principles. Sometimes you are just recognizing the expenses, but you haven't booked the revenue. So revenue is still, your team is working and it's still going to take a time to complete that project. So that's also the incorrect. So the matching principles is very important. How you're going to avoid that? Ensure that your accounting team is well versed in generally accepted accounting principles, that's a gap, or international financial reporting standards, IFRS, depending on your jurisdictions, or Indian accounting standard. Failure to disclose contingent liability. Non-disclosing contingent liabilities can lead to a significant understatement of a company's liabilities, misleading stakeholders about the company's financial health. So, contingent liability, we have to do the report. If you have the any contingent liability, that's just going to be there. If any assessment is going to be, we are not sure about that, how much liability is going to be. But yes, there should be some provisions, there should be some contingent liability we have to disclose. How to avoid them? Always disclose contingent liabilities in the notes to your financial statements, even if the likelihood of the liability becoming real is low. Next is going to be inaccurate inventory valuations. So you have to do the focus on the inventory valuations as the team is overloading the other expenses, other charges on the inventory or not. That's important. Just the raw material cost is not going to be work. In addition to that, if you incurring any other expenses, non-recoverable taxes, that's also we have to upload over there. Freight forwarding charges, that's also we need to upload on the inventory. The mistake, inaccurate inventory calculations, valuations can lead to incorrect cost of goods sold, affecting gross profit and net income. It's going to be straightway impact on the P&L. And how to avoid them? Regularly conduct physical inventory counts and use an appropriate inventory valuations method, FIFO, LIFO, or weighted average. First in, first out, last in, first out, or weighted average method, consistent with your business model. So that's going to be the inaccurate inventory valuations. Not reconciling accounts regularly. This is also the one of the biggest problem related to financials reporting. We have to reconcile accounts regularly. The mistake, failing to reconcile accounts regularly can lead to discrepancies between your company's record and actual financial positions. This is based on the real experiences that in the last month, on this before 20th itself, uh, I received the one text from one of the directors stating that this month our GST liability is too high. Can you just recheck once? Then I was sure, give me some time. Then I reached to the respective accounts department and ask the questions. Where is the GST reconciliations? What's there in the books? How much is the unutilized credit is there? Then you don't know. The picture is that some 8 lakh is going to be difference. What's its payable and what's there in the books. And what's the reason for that? We haven't done the GST reconciliations. It means that team haven't yet performed the reconciliations towards how much is balanced into the books versus how much is on the portal. At least the how a quarterly reconciliation is required. Once the month is over, if it's a quarterly reconciliation, at least from the till the last quarter, if it's a March is going on, at least till December, we have to be reconciled. But if still on a March that reconciliation is not there in the place, then at the end of the day, we are going to end up by paying that amount to the government, or else we have to pay the interest on that. And whatever is there in the books for which we haven't utilized the credit, we haven't claimed that credit while filing the return, that's going to be create a problem. So you have to ensure that you you're asking your team to perform the reconciliations regularly. How to avoid them? Implement a regular schedule for account reconciliations. This process should be through comparing internal financial records against external statement, and this is a very important. Next is going to be overlooking small transactions. The mistake, ignoring small transaction because this seems insignificant, can lead to a cumulative error over time, affecting the accuracy of financial statements. If you are not looking towards the small transactions, but today's small transaction going to be the big in the futures when we are accumulating that, then we are able to say how much is the expenses incurred and how is every month that expense is incurring. Then we are going into the depth, because since at the end of the year that number is huge, that's a cumulative errors because we haven't put the focus at a first. That's reason overlooking of the small transaction is going to be create a mistake. How to avoid them? Treat every transaction, no matter how small, with the same level of importance. Implement a system that tracks all transactions accurately. Inadequate documentations, the mistake. Lack of proper documentation can lead to difficulties in tracing transactions, making audits more challenging and potential leading to non-compliance penalties. We are heading towards the year end. We have to do the audits. We have to support for the audits. And when we are going to do that, if you don't have the backup for your transactions, then it's going to be more challenging for us. Auditor is going to ask the questions, where is the backup of that? And if you are not able to provide the backup details for that, then it's going to be create a more challenge. That's going to be lead to non-compliance penalties. So inadequate documentation is the biggest mistake towards the accounting and finance. How to avoid them? Maintain a robust documentation systems. Every financial transaction should be supported by appropriate documentations, which should be stored securely and be easily retrievable. Whatever we have to do in the systems, there must be some backup for that. We can't do the accounting into the air. So if you ask me, you have to put the controls in the system. So without backup, the system is not going to post the any single entry in the systems. The backup is going to be the mandatory, narration is going to be the mandatory, or else system is not going to allow you to post the transactions. And if the system itself is have a control, at least 90% accuracy is going to be there. And if the someone is just this is a mandatory and he is attaching something else, then that's going to be traceable. We are able to know that what he attached, we can able to see who attached. And if that's there, then such kind of persons is not required in the organizations. So that's going to be there. We have to do something for that. And the last, ignoring the importance of the professional judgment. This is important, boss. Don't try to estimate yourself as a superman. So the mistake is going to be a key danger of partial knowledge is the human tendency to fill in the gaps of our understanding with assumptions or misconceptions. This can lead to a distorted view of reality, as the made of half can be far from accurate. Relying solely on own and inadequate experience judgment and ignoring the importance of a professional judgment can lead to errors in financials reporting. So that's going to create a problem. Then how you're going to overcome with that? Always apply professional judgment, especially in complex transactions or areas where accounting standards allow for interpretations. Remember, the integrity of your financials reporting is not just about compliance. It's about providing a clear, accurate picture of your company's financial health, which is crucial for informed decision making. And stay vigilant, stay informed, and stay ahead of the game. That's going to be there. That's what we discuss here. Thanks, guys, for being with us till the end. And we discuss how the financials reporting common mistakes going to be there, how you have to avoid them, what common mistakes going to be there, what's the scope, and how you're going to avoid that. Thanks, guys, once again for being with us. Request viewers to like, share, and subscribe our channel to get a more insight towards accounting and finance. Thank you.